Hey, welcome to Office Hours. Coleman Certified SBA 7A Loan Underwriting Week 3 with our stealth panelist, Nathaniel Booker. Nathaniel, what do we have to do to get you on camera?
Pay me.
We will not be seeing Mr. Booker this session. Yeah, your agent negotiates a tough bargain. I forgot to read the video writer in your contract.
Hey, when I put on my makeup.
There you go. Well, it's gonna take a lot of that, I'll tell you that. I got a question. If you have any late questions, feel free to just shoot them over there to us, or use the GoToWebinar dashboard, and we'll get to that. I have some poll questions. Let's start off with that, Joseph. What do we got for number one? All right, the case this week was Gray's Dry Cleaning, and we have a look at his income statement. And he is 75 years old, and Mr. Gray is looking to sell the business. We've identified a buyer. Now, I know you don't have Mr. Wong's personal financial statements. It's very rough. But I'm just asking you at a preliminary level, because we've spent a lot of time going through Gray's income statement, what do you think about the deal? Do you think that possibly, maybe a possible loan, you're 50-50, doubtful, I've already turned it down and I moved on, I want nothing to do with this deal? So I'm just sort of curious on where you're at. And this case is not in week 4, but it's going to come back when we talk about business acquisition, and it'll recur throughout the course. So I will give you more information about that. And let's see, appreciate the responses. 57% of you say, yeah, possibly. I know I need a lot more information, but I'm open. 38% are 50-50. No one's doubtful, and I got 11% who say I've moved on. I don't want anything to do with this thing. No right, no wrong answer. I think all those are appropriate. Let's pull question number 2, Joseph. I've underwritten a commercial property acquisition loan. Yes or no? How many of these loans have you done in your lifetime, Nathaniel?
Wow. So your portfolio that we worked on in government funding, you and I worked together, is over 1,000. I would say probably 90% of those were.
Yeah, absolutely. 2/3 of you have, 1/3 of you have not. Next question is specific SBA. Have you done one for an SBA commercial real estate loan? And I appreciate your responses. It helps me to tailor my remarks a little bit more narrowly. And it's flipped. 1/3 of you have, 2/3 of you have not. Okay? And the last poll question is Gray's net profit that he's showing on his Schedule C on his income statement is the same as cash flow. Yes or no? And Nathaniel, we're preaching to the choir. 100% of the audience says net profit is not the same as cash flow. How's that make you feel?
That's correct.
And as I say in the week's class, that the income statement is a CPA prepared statement, and the CPA has different agenda than you do as the underwriter. And very important that you go in and tear it apart to use it for your means. We only want to do things. We're back in the old Watergate mentality. We just want to follow the cash. We don't care about exotic accounting treatments. That's depreciation and amortization and prepaid expense. And someone fell off their chair. I hope that wasn't you, Nathaniel.
No, I was just scooting. I'm still in my chair.
This is what we talked about this week. We talked about introduction to financial statements. We went through revenues and cost of goods sold. We talked about expenses. And this is one of the two add-on weeks that we've added. Nathaniel and I went through the schedule, and we've expanded it from 8 to 12 weeks to give a little bit more of an overview and an overall background. So I hope you've enjoyed this week. The takeaway that I have is, does it make sense? Do the numbers make sense? Take a step back. Look at it from a 30,000-foot level. Do not be a checklist underwriter. Just because we have to get this and we put it in the file, take a step back and look at the numbers. Does this make sense? Do you understand what's going on? Do you understand the deal? And Nathaniel and I made a very strong point on this. If there's a number you don't see, don't be afraid to ask. Find out what that number is. Find out what's going on. Very important from that standpoint. See, this is another one of those pauses, Nathaniel, where you get to jump in and show everyone how smart you were.
With regard to the add backs of cash flow?
We're not there yet. Oh, I guess we are.
Okay. Yes, we are.
Well, but comment on my other thing. How many times do you see a number on a financial statement where you go, I got to pick up the phone and talk to someone? How often does that happen? Now, I know that you're
It's not that often. It's not that often unless I see something unusual.
Yeah, but how often? 10% of the time? 5% of the time? Yeah. And don't be. My point is, if you see something, and so not to put words in Nathaniel's mouth, but 1 out of 10 times, just pick up the phone and talk to someone. If you see something you don't understand, find out what it is. Nathaniel, what are the common add backs to cash you will give a company credit for?
Depreciation, interest expense, and rent if they are acquiring a new facility to replace the one that they're in now.
I understand the depreciation expense, but then also don't we have to go in, and this is the trap in Gray's, don't we also have to anticipate what we're going to pay for equipment for the coming year? Don't we need to subtract that out?
Well, that's, when we're talking about add backs, that would be just an additional expense that you would deduct.
Right.
That is an add back.
Right.
That would be for CapEx, and that's what you're referring to.
The question was referred poorly. I probably should. Common changes to cash flow that you should add back as well as subtract. The point is, it's fine to add depreciation. Everyone does that, but have an understanding on if there's going to be a significant equipment expense. And I'm not talking about a fax machine. I'm not talking about items that have been historically included in an office expense or small items. But in Gray's, the trap is we think there may be a $50,000 bill to buy some equipment, and we need to adjust cash flow for that. Nathaniel, you've done both. Is SBA require the underwriter to do anything differently to calculate cash flow than on your conventional loans?
No, there's no material difference.
Yeah, and I think that's critical. I think when you talk about SBA, you're an underwriter. You're a commercial loan underwriter. The only difference is we've got to do some documentation thing. I've hammered home the 1920. If we follow that 1920 checklist, you're going to feel comfortable doing an SBA loan as if you would a conventional loan. So don't worry about that from that standpoint. Finally, Nathaniel, you and I have talked a lot about this. How important is it to understand an applicant's affiliate business from an SBA standpoint?
It's very important because the affiliate could be dragging on the primary borrower. For instance, they'll have to fund the affiliate business. And so when determining global cash flow, that would reveal whether or not the affiliate is adding to the cash flow or reducing the cash flow.
I raised this question for the class because in week 5 we're going to go into global cash flow, and the takeaway from week 5, 2 weeks ahead, is SBA may not require you to get that affiliated financial statement. But Nathaniel, we're going to look at their K1, we're going to look at their personal tax returns, and we're going to see a hole of cash coming out. And just because SBA may not require you to get that affiliated statement from a cash flow statement, you may have to do that.
Makes sense to me. Yeah, because I've seen a number of SBA review, a number of SBA lenders and SBA loan files that the K1s are not used for global cash flow determination. I think that's a major omission.
Mm-hmm. Great.
That should not occur.
Cool. I got a nice comment on the book. They said they finished it. Thank you very much. And I don't disagree with this. Contents is your choice. I'm sorry, I don't understand the second part of it. Maybe it was a typo from that standpoint. Thank you for that comment. By the way, there are 2 errors in the book. And I have a gift card if someone can tell me what the 2 errors are. One is historical, and one is lending. So I have a $25 Amazon gift card if you can point those out to me. And I'll even go one step further. If you picked up another I don't know about, I'll take that as well. Week 4, we have a new case, Nathaniel. I don't think you even had a chance to read it. It's Franklin Brothers Industrial, Inc. Joe Franklin opened up a one-man machine shop in 1946, right after he got out of the Army after World War II. I actually had, in the early 80s, I made loans to a gentleman, with this case I loosely based on, built up a very nice business in Southern California, San Fernando Valley, sold to the aerospace business, worked on the Apollo, worked on space shuttle. So we're saying that Joe Franklin's sons have taken over. They've gone on that tradition, and now they're now into sophisticated 3D printing. They're on the Orion spacecraft. They're doing specialty machine tools, machine parts. I wanted this case a little bit more complicated than Gray's because I need to have accounts receivable. I need to have inventory. We're going to be talking about financial ratios in week 4. And I do have an assigned reading. I just gave you the simple Wikipedia on financial ratios. Don't memorize those, whatever, but I want you to get a flavor of what all the financial ratios are out there. And especially if you're using a sophisticated or an unsophisticated spreadsheet analysis program, you're going to have a bunch of ratios thrown out at you. The only ones that I focus on are the ones specifically in the SBA: debt to worth, discretionary service coverage ratio, AR turn, AP turn, inventory turn, just some very, very basic ratios. You can that's the lower bar that SBA has. Actually, I think SBA only requires debt to worth and current ratio. Nathaniel, you mean I don't have those notes in front of me. I go through them in the class. But the point is, go ahead and do the couple that they demand. You may want to do some more from that standpoint, but you don't need to be an expert of all of those. Understand what they want. So I want you to read the case study. It's one page. I give you the financial statements as well as a pro forma. We're going to go through a pro forma analysis from that standpoint, and then the financial ratios. So it's a fairly light week from that standpoint on that. When you're doing pro formas, Nathaniel, any tricks you want to tell us?
No. And this is why it's important for using some of the ratios, because you can use those as metrics to develop actually projections.
Right.
But which is a little bit different in pro forma in some cases.
But we use them very much as a trend to see what's happening.
Yes.
And that's, if I tell you, Nathaniel, this company has a 49% gross profit margin, your eyes glaze over, you don't know what that means, but say, hey, last year, and I'm not saying these are the numbers, but if you see that gross profit margin trend going down, that's a red flag. Obviously, in the case, I do have some traps. We have a company which is screaming for cash, and you'll pick that up very quickly. We have a very high accounts payable turn, and we have a very high accounts receivable turn. So we have some issues with this. But this is a standard commercial real estate acquisition. There's busting at the seams. They need to move. So it'll be a fun case from that standpoint. And on the case, feel free to ask me to elaborate more. We can make these as fun as we want. Do we have any more questions, guys?
No, that's cool.
Hey, I'm enjoying the class. I appreciate your feedback. Thank you very much.
Yeah, hey, Bob.
Yes, sir.
I want to make a comment. When you said pro forma, I didn't see the balance sheet. If they were referring to a pro forma balance sheet,
Yes,
not projections.
yeah, right.
Okay.
Yep. Yeah. Well, this week we'd go through pro forma balance sheet, and we have projections. And speaking of the syllabus, this is what the new syllabus looks like. Joseph, do they have access to this? How do people?
Yes.
Okay, everyone should have access to this. And you can see we've rewritten it a little bit to make it a little bit tighter. But I definitely want to address the balance sheet and the ratios, and so a little bit of 101 underwriting. But you can see, well, week 5, we're going to tear apart those financials, those tax returns. Use of proceeds, that's probably more important from an SBA loan, so we'll spend a lot of time on that, obviously. Then we'll get into SBA loan conditions, week 7. Week 8, special financing situations. Gray's is going to come back as an acquisition package. We'll also wrap up Franklin Brothers. And then we talk about the credit memorandum, specifically what we need to do at for under 350 and over 350. And I want you to feel comfortable with that from that standpoint. And I broke that out for 2 weeks. So with that, everyone have a nice weekend. Nathaniel, thanks a lot. We'll talk to you all next Friday.
Thank you.
Thanks.